There you go.
All right, we'll get started. We are getting started. We have a lot to cover today, but thank you everyone for joining us for today's webinar. Today's webinar is preparing for the restart of student loan payments. Let me start with some housekeeping items. Throughout the entire webinar, your video, microphone, and chat feature will be turned off. This event is being recorded and it will be available to you on DFPI's YouTube channel within the next few days. My name is Selena Damian, and I am the Student Loan Servicing Ombudsperson at the California DFPI, Department of Financial Protection and Innovation. Part of my work as a Student Loan Ombudsperson is to conduct education and outreach to Californians with student loans. And now more than ever, it is important that everyone is informed about their payment options and their student loans. I get a lot of questions on repayment options, so this is going to be a great webinar with lots of information. Let me start off. It is my pleasure today to be joined with Betsy Mayotte, who is the president and the founder of the Institute of Student Loan Advisors. She has been working in the student loan industry for over 20 years and has helped thousands of borrowers with their student loans. This is the second of 5 student loan webinars, so please subscribe to our DFPI page to get more information on future webinars and dates. Before I hand it over to Betsy, I want to go over the agenda. We're going to be covering payment plans, examples and strategies for repaying your student loans, other options, and then what to expect when repayment starts. Before we get into repayment options, just briefly, who is DFPI and what do? We are California's Consumer Protection Agency, and we regulate companies of financial products to ensure compliance, and that includes student loan servicers. Servicers are the borrower's main point of contact. They are the company that you will be calling to inquire about your bills, where you make your payments, repayment plans, change plans, or about your forgiveness options. We also accept and evaluate consumer complaints against servicers. So now more than ever, it is important if you're having a problem with your PSLF count, with not getting the correct information, you can go ahead and file a complaint through DFPI. We take enforcement and legal action when companies are not in compliance, and we conduct education and outreach such as this one to enhance consumer awareness and protect California consumers from fraud. Next, please. About TISLA. TISLA is a nonprofit agency that offers free, expert, unbiased student loan advice and dispute resolution to all consumers. They work with consumers not just in California, but nationwide, and have nationally recognized student loan experts on hand to help borrowers. Their website address, freestudentloanadvice.org. Next, please. And just briefly about a protection for California borrowers, the California Student Borrower Bill of Rights went into effect January 1st of 2021. In addition to the protections that are offered to borrowers on the federal level, California has these protections for borrowers. These protections apply to student loan servicers doing business in California, including state licensed servicers as well as banks. And it applies to borrowers with both federal and private loans. And California is only one of 13 states that has this advanced legislation to protect borrowers. And what it does, it prohibits servicers from engaging in abusive, unfair, or deceptive practices. It requires that servicers provide borrowers with accurate information about their repayment options, income-based repayment plans, or federal forgiveness plans. So everything we are talking about today. It requires that servicers respond to a borrower's qualified written request within 30 days. If you need information on your account history, on your PSLF count, if you request it, they should be responding to you within a timely manner. Establishes special protections for military borrowers, borrowers working in public service, older borrowers, and those with disabilities. Next, please. The questions. So for today, if you have questions throughout the webinar, they can be posted in the Q&A panel on your screen. To ensure we can answer as many questions as possible, please wait until the topic is covered. you will most likely get that question answered. And then we also suggest that you do not ask detailed personal questions, as this is a public forum. You can always reach out to us with those questions after the webinar. And with that, I will hand it over to Betsy to get started on our repayment options. Thank you.
Thanks, Selena. Great introduction. I just want to add another introduction. With us today, we also have Addison. Addison is also with TSLA. He's going to be working in that Q&A panel. As Selena mentioned, I would hold off on asking your question until we cover that particular topic. If I'm doing my job right, I'm going to answer that question for you along the way. Every once in a while, I'm going to take a breath and ask Addison if there's any questions that he's received that he thinks might be good for the whole group to hear. And if there are any, we'll talk about them. We have a ton to cover today in a very short amount of time. So I'm also providing you with a lot of resources. Hopefully you walk away with from this session with everything as clear as can be. But again, we have a ton to cover in a small amount of time. So I recognize that some of you may walk away with your head spinning. Hopefully, I hope that not to be the case. But at the end of this session, there is a series of resources that you can go to find more information about the topics that we're covering. And of course, you can always reach out via email to either DPFI or TSLA for more explicit advice. So where we're going to start today is repayment options. So, student loans, most federal student loans have been on pause and have had 0% interest for over 3 years, which, I've been working in the student loan industry in a compliance and advocacy role since the earth cooled, and nothing like this has ever happened before. And I don't expect it to ever happen again. This is an extraordinary time. And it's leading us to another extraordinary time, which is about 40 million borrowers all re-entering repayment at exactly the same time. So there's probably going to be bumps in the road. Certainly the servicers are going to have a lot of extra volume that they don't normally have. So the more that you can research on your own, at least initially, and figure out what the best payment plan is for your both short and long-term financial goals and circumstances, the better. So I'm going to cover the different repayment options that are available to most federal student loan borrowers. Now, the problem with a lot of these, especially the group that I'm covering first, which are the income-driven plans, is they're all exactly the same except where they're different. In fact, if you look at the screen in front of you, you're going to see that 2 of them have the exact same name, but they have completely different terms. So that does get confusing. On our website, there is a chart that helps you do a side-by-side comparison of the rules of the different plans, the pros and cons of them. Excuse me, it's under the repayment plan section of our website. Or if you just want to know what the lowest payment's going to be, or what plan will cost you the least amount over time, the Department of Education has something called the Loan Simulator tool. That tool can be found at studentaid.gov, and all you have to do is plug your information in once, and it'll tell you what your plan will be, what your payment will be under each plan, and more importantly, how much you will pay out of pocket over time. Because again, the name of the game is paying the least amount over time, not necessarily getting the lowest payment. So there's really 2 groups of repayment plans for federal student loans. The ones that are based on your income, that from an umbrella term perspective, we call the income-driven plans or IDR plans. And then there's the ones that aren't based on your income. We're going to start out talking about the IDR plans. Under that umbrella, we have 5 different plans. We have what's called old IBR. That's the only income-driven plan that's also available to people that have the older Federal Family Education Loan Program loans. So back before 2010, there were actually 2 federal student loan programs, the FEL program and the Direct Loan Program. They both have Stafford loans. They both have Graduate Plus loans. They both have Parent Plus loans. They both have consolidations. If you aren't sure which you have, this I can tell you, if the loan was taken out after July of 2010, it's absolutely not a FEL loan because they stopped making them on June 30th of 2010. If the loan was taken out before that period, you should check with your loan servicer. If you, excuse me, if your loan has been on pause for the last 3.5 years, chances are it is a direct loan. Most FFEL loans were not eligible for the COVID pause. Worst comes to worst, you call your servicer and you ask. They'll be able to tell you right away whether you have a FFEL or a direct loan. But again, the what we call old IBR is the only plan that's available for both FFEL and direct loans. New IBR is only available for direct loans. The pay-as-you-earn plan is also only direct, as is Repay/Save and ICR. One thing about income contingent repayment is it's the only plan that's available for Parent Plus loans, and only if they consolidate those Parent Plus loans. Now, there is a loophole that is available until July of 2025 for Parent Plus loans. We call that the double super secret consolidation loophole, where if a Parent Plus loan is consolidated twice, then it can potentially be eligible for Repay/Save or these other income-driven plans. We don't have time in this session to go into the details about the double super secret, not so secret anymore, consolidation loophole for Parent Plus, but we have step-by-step instructions on how to do that and what that is on our website at the bottom of our consolidation page. All right, and I'm going to explain more about how the income-driven plans work in a second. The payment plans that are not based on your income, they're based exclusively on your balance, are what's called the standard repayment plan. Now, that's the plan that you're automatically given if you don't choose something different right when you get out of school and go into repayment. That plan is the same payment amount every single month. You pay that payment amount for 10 years, and at the end of that 10 years, the balance will be paid in full. There's no forgiveness component to it. If you have a small balance, you're going to end up paying it off in less than 10 years. The smallest payment that you can have under the standard repayment plan is $50. So let's say you only owe $3,000. If you're on the standard repayment plan, they'll give you a $50 a month payment, and you'll end up paying it off within about 5 years. There's also a standard repayment plan for a consolidation loan. It works the same way in that your payment's the same every single month until the loan is paid off. The difference is that instead of it being over 10 years, it's over between 12 and 30 years. Graduated repayment, you're making interest-only payments for the first 2 or 4 years, and then payments gradually increase over time. You're still paying that loan off within either the 10-year standard plan or if you've consolidated in the 12 to 30-year window. Extended repayment is sort of like consolidation without consolidating. If you have separate loans and you owe at least $30,000, if you apply for the extended repayment plan, they'll base your payment off of a 25-year term, and you'll make the same payment every month until it's paid off or until you hit the 25-year mark. It's similar to the standard consolidation plan, but you don't actually have to consolidate your individual loans into a single loan to get this term. Why someone would want to do that versus consolidation is there's some borrowers that their strategy for paying their loans off is to pay the minimum due on each individual loan and throw extra money at the highest interest loan first. You can't do that if you've consolidated because you don't have separate loans anymore. You have a single loan. So one way to lower the payment but keep that strategy might be to do the extended repayment plan. Now, all loans, including FFEL loans and including Parent Plus without consolidation, are eligible for all of these plans. What you need to know, however, is that if you're pursuing forgiveness, either under public service loan forgiveness or the forgiveness component that's sort of already baked in to the income-driven plans that we're going to talk about in a minute, that these payment plans do not count towards the number of eligible payments you need to get forgiveness under either PSLF or the income-driven plans. All right, let's go back and talk about the income-driven plans. So one thing that the income-driven plans have in common is that they all use something called your discretionary income to determine what your payment's going to be. Now, the discretionary income is calculated pretty much the same way amongst all the plans, whether you're looking at IBR or Repay or Pay As You Earn or ICR. What they're doing is they're taking your adjusted gross income and then they're subtracting a percentage of the poverty line that's based on your family size and the state you live in. Now, if you're looking at income contingent repayment, they're using 100% of that poverty line. If you're doing Repay/Save, they're using 225% of the poverty line. It used to be 150, but that changed on July 30th to 225%. And if you're using old or new IBR or Pay As You Earn or the old Repay plan, they're using 150%. Now, your AGI, if you're married and you file your taxes as married, regardless of which income-driven plan you're on, they're going to use both of your incomes in the calculation. Now, if you're married and you file your taxes separately, they're only going to use your income. However, you're going to have to reduce your family size by 1 for that whole poverty level piece, because you can't count your spouse in the family size if you're married and filing your taxes separately for the purposes of the income-driven repayment plan. Now, if you live in a community property state, which I believe California is, if you're married and you file separately, they actually use half of the total income between the two of you. Now, there used to be an exception for this for the Repay plan, where they used the spouse's income regardless of your tax filing status, but that went away on July 30th. Now, again, if you're not a math person, don't worry about this. The calculator at the Department of Ed site is going to do all of this for you. But I know a lot of people, myself included, that things sometimes make a lot more sense if you know what the math is, which is why I'm doing the math with you now. The math is actually fairly easy to do by hand as well. Excuse me. So the way these plans work is, as I mentioned, they take your adjusted gross income, they subtract whatever percentage of the poverty levels being used for that payment plan. For this particular example, we're using 150%, so that's what it would be for IBR or Pay As You Earn. And so here's an example. We have a borrower whose adjusted gross income is $62,000. They have a family size of 4 and they're living in Maryland. So their poverty level would be $26,200, and you can find that online. And we have a link to the poverty levels on our website, I believe. So 150% of $26,200 is $39,300. So we subtract that from the AGI, and that gives us $22,700. That's what they're calculating your payment off of. So if you divide that by 12, that gives us $1,892. So for the payment plan, such as new IBR and Pay As You Earn, they're going to take 10% of that, and that gives you a payment of $189 a month. If you're using old IBR, they're using 15% of that, and therefore your payment would be $283 under old IBR. Now, for Repay/Save, as I mentioned, as of July 30th, they're actually using 225% of your poverty level for your family size. So in that situation, for this borrower, their payment, the income that would be left over after subtracting 225% of their poverty level would only be $3,000 and change, which this year would give them a payment of $25.41. And then assuming they have next year, another aspect of the SAVE program will be effective, where they're only using 5% of your income, for any portion of your loans that are undergraduate loans. So in this example, if the borrower had all undergraduate loans, this year their payment would be $25.41 a month. Next year their payment would drop down to $12.70 a month. So you can see that one of the reasons the Biden administration was really excited about this new version of the repay program that they're calling SAVE is that it can potentially drastically reduce your monthly payment amount, which if you're struggling with payments or if you're pursuing loan forgiveness, it's going to be extremely impactful. Now, the other thing that you need to keep in mind for some of the income-driven plans is some of them require that you have what we call a partial financial hardship to get into the plan in the first place. Now, this applies to both IBR plans, so old and new IBR, as well as pay-as-you-earn. Now, a PFH exists if your calculated payment under those income-driven plans is less than what your payment would be under a regular 10-year standard repayment plan. So, for example, if we use the example we used on this prior slide, so we have, adjusted gross income of $62,000, family size of 4. If that person owed $60,000 in federal student loans, their payment under a 10-year standard plan would be right around $720 a month. Now, $720 a month is higher than either both $189 or $283. So this person would have a partial financial hardship and therefore would be eligible to potentially get into either old or new IBR or the pay-as-you-earn plan. Now, once you're in those plans, you don't have to maintain a PFH to stay in them. If your income goes up to the point where your payment would be equivalent or higher to, in this example, the $720, they would just cap your payment at that. And you would not be kicked out of the program. You could leave the program and apply for a different repayment plan if you wanted to. But you could, if you wanted to, you could also stay in either pay-as-you-earn or one of those IBR plans. And again, your payment would never go above that 10-year standard amount. Now, for the plans that don't require a PFH, which is income contingent and repay/save, you don't need the PFH, so any income can get into those plans. But there's also no cap on your payment. So it's possible that your payment could be a lot higher than it would be under the 10-year standard repayment plan. Now, again, depending on your financial situation and goals, that may not be a bad thing because, again, the name of the game is paying the least amount over time. And for some people, that's going to mean paying their loans off as aggressively as possible. So now that we've explained how the payments are calculated, and now that we've explained what a partial financial hardship is, I'm going to quickly go over the individual plans themselves so we understand which has which benefits, and so we can also talk about interest subsidies. But before I do that, I want to check in with Addison to see if there's any questions about anything I've covered already.
No, not yet.
All right. Let's get in there. So, all right. So let's talk about old IBR. So again, old IBR is the only plan that those FFEL borrowers are also eligible for. And if you have a FFEL loan, doesn't matter if it's a Stafford loan, a Grad Plus, a Consolidation Plus, as long as it's not a Parent Plus or a consolidation that contains a Parent Plus that didn't go through the double consolidation, it's going to be eligible for old IBR. Now, old IBR uses 15% of your discretionary income. It uses 150% of the poverty level. You are required to have a PFH, so your initial calculated IBR payment has to be less than what you would pay under the 10-year standard plan. Now, it forgives any balance that's left over after 25 years on this plan or any combination of the IDR plans. So let's talk about the forgiveness component that's baked into the income-driven plans. All the income-driven plans have such a forgiveness component baked in. They also all cross-pollinate. So what that means is that if you're on an income-driven plan for either 20 or 25 years, and the sort of the goalpost there depends on which plan it is, and in some cases, what kind of loans you have. But if you're on any type of income driven plan for either 20 or 25 years or a combination of the plans, if you still have a balance at the end of that period, they're going to forgive it, including any outstanding interest. Now, again, you don't have to be on the same plan. You can go from old IBR to repay, back to old IBR or ICR. All that's fine. It's changing plans does not reset your count. Now, there is something that's actually been really heavily in the news lately. There's a one-time account adjustment waiver where the Department of Education is going to go into most federal student loan accounts sometime between now and the end of next year. They have like 25 or 30 million accounts or more to go through, so it's going to take a minute, and give people credit for past periods of repayment where they weren't on an income-driven plan. So some of you who have never been on an income-driven plan before, at some time over the next year, are going to actually see a count for income-driven plans. And that's awesome that they're doing this. They're running on the assumption that if people had been counseled more on the income-driven plans, maybe they would have been on an income-driven plan in the past. But what you need to know is that if that account adjustment isn't going to immediately give you forgiveness, and it won't unless you've been in repayment for 20 or 25 years or more already, that you will need to be on an income-driven plan going forward to accrue the rest of your payments. There's not going to be another Hail Mary like that. Now, I'm sure a lot of you have a lot of questions about that waiver. That's a whole presentation in and of itself. But there's I have a link to it at the end of this presentation on the Department of Ed's website that explains it, and there's also information about it on our website on the repayment plan page. But what you need to take away from this for this purpose is that you need to actually be on an income driven plan for the 20 or 25 years to get forgiveness. The one exception is that for past periods, the Department of Ed is actually going to give people credit for past periods in this one-time adjustment that's coming up. Now, new IBR is only for direct loans and no Parent Plus loans unless they've gone through the double consolidation. It's only for borrowers who all their loans were taken out on or after July 1st, 2014. Now, if you have loans from before that and then consolidate, that doesn't make you eligible for this. It's based on when you took your first loans out. My apologies. New IBR uses 150% of the poverty line and 10% of your income, and it forgives your balance after 20 years on this plan or a combination of the plans. Now, this plan, as well as old IBR, has an interest subsidy. And the interest subsidy applies for these plans only for whatever portion of your student loans are subsidized. So that would be a subsidized Stafford loan or a part of a consolidation loan that's subsidized. And the way this subsidy works, it only applies to the first 3 years that you're on any type of income-driven plan. But the way it works is, if the interest you're accruing on the subsidized portion of your loans is more than the amount of your payment that's calculated under these plans, the government's going to forgive the difference. So let's say, for simplicity's sake, that all you have are subsidized Stafford loans, and you're accruing $100 a month in interest, and your calculated payment under either new or old IBR is $50 a month. For the first 3 years you're on the plan, the government is going to pay that other $50 in interest that's accruing because it's more than what your calculated payment is. Now, if you pay extra on the loans, so if your bill's $50 a month, you're accruing $100 a month in interest on those subsidized loans, and you choose to pay $200 a month, that's awesome. It will not reduce your subsidy. You'll still get that other $50 forgiven. And so therefore that extra money will most likely, in most cases, go directly to principal. I say in most cases because if you happen to have a buildup of past interest, that has to be paid off before any money goes to principal. The pay-as-you-earn plan is exactly like new IBR. They are fraternal twins. The reason I say they're not identical twins, the only difference between the two is that, so whereas new IBR, you have to have no loans made prior to July 1st, 2014 to get into it. With pay-as-you-earn, you can't have any loans older than October 1st, 07 to get into it. And you also have to have at least one disbursement of a new loan on or after October 1st of 2011. Now, one thing I want to point out, because it's really important, especially when we start comparing these plans to repay/save, is that these plans, if you're on this plan when you hit the 20-year mark, they're going to forgive the balance at that moment. So after 240 eligible months, and that's both for new IBR and pay as you earn. That includes if you have graduate loans. So again, if you have graduate loans, undergrad loans, double consolidated parent plus, if you're on pay as you earn or on new IBR, when you hit payment 240, they're going to forgive the whole balance. So put a pin in that. All right, let's talk about the latest, the most recent income-driven plan, which is called Revised Pay As You Earn. They are now also calling it the SAVE plan, and at this point, those are one and the same. The eligibility for this is the same as the other plans we recently talked about. All direct loans are eligible. Of course, Parent Plus loans have to be double consolidated to be eligible. For this, the payment calculation is for this year, they're using 10% of your discretionary income. They're using 225% of your poverty level. So for that reason alone, amongst the plans, for most people, not everyone, and I'll tell you the exceptions in a minute. For most people, amongst the IDR plans, SAVE is going to be your lowest monthly payment because they're using the 225% of the poverty level. Starting next July, for any portion of your loans that are undergrad, they're going to use 5% of your discretionary income rather than 10. And for any graduate loans or double consolidated parent plus, they're going to use 10%. And if you have both, or if you have both consolidated together, they're going to proportion that out. So for example, if you had 50,000 in undergraduate loans and 50,000 in graduate loans, they're basically going to use 7.5% of your discretionary income to determine what your monthly payment amount is. You don't need a PFH to enter into Revised Pay As You Earn or SAVE, but of course that also means there's no limit to how high your payment can go. Now, here's where it gets interesting. The interest subsidy for repay/save is much more generous than the other income-driven plans. So essentially, what it used to be is it would be 100%. It was 100% for subsidized loans for the first 3 years, and then 50% for all loans for the entire time you're on the plan. But now, effective this past July 30th, for all your loans and for as long as you're on repay/save, they are going to forgive 100% of the interest that's not covered by your calculated payment. So it doesn't mean that you're not accruing interest. So let me give you a couple of examples. So let's say that you're accruing $100 a month in interest on your loans and you're on repay/save, and you get a calculated payment amount of 0. The government's going to forgive all your interest for those months. Let's say, same example, you're accruing $100 a month in interest and your calculated payment under SAVE is $50. The government's going to forgive the other $50 per month for as long as your payment's $50 a month and as long as you're making that payment. If you don't make the payment, they're not going to give you the interest subsidy. Here's example number 3. Let's say that you're accruing $100 a month in interest And under revised pay-as-you-earn/save, your calculated payment is $250 a month. At that moment, you're paying all the interest. They're not waiving any of it because your calculated payment is higher than how much interest you're accruing per month. Now, if you are getting an interest subsidy, so let's go back to my example where you're accruing $100 a month and your payment's $50. If you choose to pay extra, just like with the other interest subsidies, that should go to principal. The only reason it wouldn't is if you had extra interest that had accrued in the past that has built up. That has to be satisfied before any money can go to principal. Now, the forgiveness piece of SAVE is a little more complicated than the other plans. If you have only undergraduate loans, like you never had even $1 of graduate loans or Parent Plus, they're going to forgive your balance after 20 years on the SAVE plan. If you have even $1 of graduate loans, the whole thing will not get forgiven until 25 years. And that doesn't matter whether they're consolidated or not. Now, in most cases, you cannot be on different plans for different loans. You have to be on the same payment plan for all your loans. So there's no like backdoor way to get your graduate loans forgiven early while still getting benefits for the SAVE plan. Now, related to that, I want to go back to pay as you earn and new IBR. So remember, these two plans forgive even graduate loans after 20 years. So there's a strategy out there where some people were on repay for the interest subsidy, and then they plan right before they hit year 20 to flip over to pay as you earn or new IBR if they were eligible for either of those two. Effective now, if you are not actively on pay as you earn on July 1st of 2024, you will never be able to get on it. For new IBR, if you've already been on repay/save for at least 5 years or 60 months, that doesn't have to be consecutive, you will be barred from getting on to new IBR. So that sort of loophole of flipping, if you have graduate loans, of flipping from repay or save to pay as you earn or new IBR to get the 20-year forgiveness is really not going to be possible in the fairly near future. So if you have graduate loans and you're trying to figure out whether you should be on pay as you earn or save, that's really something to consider, and something, is the extra 5 years to get forgiveness going to be cheap, but have a lower payment, going to be cheaper than having your forgiveness happen more quickly, but have a slightly higher payment. There's another aspect of SAVE that will be effective next year that's causing a lot of confusion. For borrowers who only ever borrowed $12,000 or less, and by the way, that's total. That's not on each individual loan. So if you never borrowed more than $12,000, your forgiveness time, and you're on repay/save for at least 10 years, then they will forgive after 10 years rather than the 20 or 25. So if you're on repay/save for 10 years, you borrowed $12,000 or less total, and you still haven't paid it off after that 10 years, they're going to forgive it at that point. They're not going to make you do the 20 or 25. And for every $1,000 over the 12 grand, they add a year until you get to the 20 or 25. So it'll never be more than 20 or 25 years. So let's say you borrowed 14,000, then it would take you'd have to be under save for 12 years to get forgiveness. But if you borrowed 100,000, it would still be the 20 or 25. Now, income contingent is sort of the wild child here. Income contingent repayment is the only plan that Parent Plus loans are eligible for without having to go through the double consolidation loophole, although they do have to consolidate once to get access to it. ICR, the calculation is they're using 100% of the poverty level, and they're taking 20% of your discretionary income to determine your payment. So in many cases, ICR is the highest monthly payment amount for the income-driven plans. There's no interest subsidy. Forgiveness is after 25 years. But here's where it gets funky. The other calculation they do for ICR is they look at what you would pay under a 12-year repayment plan, and then they multiply that by this sort of mysterious income percentage factor that's published every year in the Federal Register. And whatever's lower, either the 20% of your discretionary income or this 12-year standard calculation, is what they give you for a payment. Now, for borrowers whose student loan balance is a lot lower than their income, oftentimes, because of this whole 12-year thing, ICR actually ends up being the lowest payment, sometimes by a lot. So I encourage people to use that loan simulator tool at the Department of Ed's website to figure out. Don't assume that SAVE is going to be your lowest monthly payment, especially if your income is high compared to what your student loan balance is. We've already covered this. We've mostly already covered this, but just as a reminder, for the income-driven plans, with the whole one-time account adjustment that I mentioned before aside, as a rule, you have to be on an income-driven plan for either 240 or 300 months, depending on the plan, and depending on what kind of loans you have to get forgiveness. Consolidation used to reset your IDR count to 0. That's no longer the case. If you consolidate by December, you'll retain the highest count of all your underlying loans. Starting in January, if you consolidate, you'll actually get a weighted average of the counts of your underlying loans if you consolidate. Again, you don't have to be on an income-driven plan for the whole period. Being on an income-driven plan, the payments don't have to be consecutive to count, but in those scenarios, the non-IDR payments are not going to count towards the 240 or 300 months that you need. Who you work for or how much you work or whether you work at all is not relevant at all to this. However, it is relevant if you're pursuing public service loan forgiveness. Now, they don't care who's actually making the payment. So we see a lot of borrowers with Parent Plus loans where the student is the one actually making the payment. That's fine. It'll still count. However, the payment amount is going to be based off of the actual borrower's income. So in the example I used, it would be based off the parent borrower's income. And all of the income-driven plans count towards public service loan forgiveness, assuming you're also working PSLF eligible employment at the time. They've also added, effective this past July, some periods of deferment that will also count towards the 240 or 300. That includes the cancer treatment deferment. There's a deferment for people in a rehabilitation program, unemployment deferment, economic hardship, and the deferments that are available for those in the military. And then effective next year, in addition to those, they'll also count periods of National Guard, bankruptcy, and some other limited types of forbearances. But other than those periods, you do actually have to be on an income-driven plan for future months to count towards the 240 or 300. So just to show you, for those of you whose heads might be spinning, let's just walk this through an example, and let's go back to our borrower from our prior example. So just as a reminder, this borrower has an income of $62,000, family size of 4, living in California. Only the borrower has loans, their spouse doesn't have loans, and they owe $60,000, and their interest rate is 5.5%. So under the SAVE plan, their payment that first year would be $0, and assuming their income went up by 5% every year, the payment would go up every year, and eventually they'd be making a payment of $425 a month. The total they would pay out of pocket would be a little under $36,000, and they would get their loans forgiven after 20 years, and about $55,000 would be forgiven. Under the 10-year standard plan, their payment would be $651 a month. They'd pay almost 80 grand out of pocket. Under ICR, they pay around $533 a month, and they pay back a total of $82.5. Now we're going to look at the other plans in a second, but clearly in this case, the borrower's best strategy will be to get on the save/repay plan, unless they're and to stay on it, unless their income goes up significantly over time, because this is the plan that is going to have them paying the least amount over time, because they're only going to pay the $35,000 versus 78 or over 80. Now, just to show you what the other plans look like for this scenario, for the graduated repayment plan where they're paying interest only for the first couple of years, their payment would start out at $370 a month and would grow over time until their last year of payment in the 10 years would be about $1,100. They'd pay back around a little under $83,000. Pay as you earn, their payment would be $142, and they'd pay back 90 grand over time. And same for the new IBR plan. For the extended plan, now remember that's the plan where you owe at least 30 grand, and they just extend the term to 25 years. Your payment would be $368 a month every month, and you'd pay back $110,000. And extended graduated, which isn't, it's those two plans sort of morph together. You'd start out at $274 and you'd pay back most of all. Now, in any of these scenarios, you can always pay back more per month than you're required, and that, of course, would reduce, in most cases, how much you'd pay back over time. And again, you can switch plans. And I just want to remind you, though, not every scenario is going to look like this. For some people, pay as you earn might be cheaper over time. For some people, the standard plan might be cheaper. For some people, ICR might be cheaper. This is just one example. In this scenario, I just wanted to show you how it could shake out a different way. It's the same borrower, but now their income is $120,000 a year instead of $62,000 a year. As you'll see in this case, ICR or the standard plans are the ones that actually will cause them to pay the least amount over time. And the save plan is actually a little bit higher by a couple grand than the standard or ICR or pay as you earn. Now, if these plans still don't work for you, if the payment's still too high, you can ask for a forbearance or deferment that will postpone the payments altogether. However, you should know in most cases interest will still accrue and that these periods might not count towards forgiveness. Payments, when you make a payment, it always goes to any outstanding interest to date first before any money goes to principal. There's never a penalty for paying extra or early, and then you can change plans at almost any time or as often as you need to. Now, with that said, I'm going to throw it over to Selena. Well, actually, first, let me check with Addison. Are there any questions you think I need to cover before we talk about the repayment on-ramp?
There were a couple questions about if this webinar would be distributed to participants.
It won't be, but it will be posted on the DFPI webpage, probably sometime next week.
That's correct. Thank you, Betsy, for that information. I know it is a lot to take in, but like Betsy said, you don't need to know all the intricacies of how things are calculated. There are tools that will help you. So how do we prepare for a repayment restart? Next, please. So as we all know, payment restart will start in October. Next page, please. Okay, so how do we prepare? We prepare by, a lot of things have happened in these past 3 years. You could have had a change of income. There were lots of servicer transfers. So you may not have the same servicer as you did 3 years ago. So what borrowers need to do to prepare, you need to log on to studentaid.gov or the FSA's main student borrower page. There under the link, you manage your loans, you can find your loan information, your loan balance, your servicer information, and your current repayment plan information. There is where you will find the simulator. You need to ensure that your loan servicer has your correct information, your email, your address, phone number. You can log on to their account to check your current repayment plan as well as their amount. So the loan amount. So you will have an account, a main account with the Department of Education, with studentaid.gov, and then with your servicer, with the company that you are making the payment. So you are going to be dealing with two different portals. You can, as we said, use the loan simulator to determine which plan works best for you, depending on your financial situation and your goal. If you're on the PSLF track, there is a tracker on your studentaid.gov account, as well as the Mohila account has a PSLF tracker, so you will know where you are with your PSLF. You can apply for a new repayment plan if needed, and as well as re-enrolling an ACH or auto debit through your servicer. If you apply for auto debit, you do get a 0.25% interest rate discount on your payments. And then for those borrowers that are in default, and want to take advantage of these income-driven repayment plans, want to get back on track, there is a program called the Fresh Start Program, which borrowers do have to opt into. There is a link at the end of this webinar. You can email me for the information as well, but it is a program that lets borrowers get out of default. Collections and negative credit reporting won't start on when repayment starts, and this program is open a year from October 1st. So borrowers that are in default will have to call their guarantee agency or Department of Education. It's a 5 to 10 minute process where you can enroll in this program to get you back on, whether you want to get on an IDR track, which would probably be the best plan, and then apply for PSLF and then get on track for forgiveness. Check all your correspondence. So any mail that you get, emails, just make sure it is from your servicer or studentaid.gov, and I will talk about that a little bit more in the next slide. Next, please. Let's talk about on-ramp program. So recently, President Biden announced this on-ramp program, which is an initiative for borrowers that are not going to be able to start repayment. Next slide, please. So this on-ramp program, it's going to be effective October 1st of 2023 and will be ending September 30th of next year. So if a borrower does not make a payment, borrowers will not be reported to credit bureaus. They will not be considered in default. So these were borrowers that are not already in default. Borrowers will not be referred to collection agencies for late missed or partial payments. Interest will not capitalize at the end of the on-ramp period. However, if a borrower does not pay, they will not get any interest subsidies offered by SAVE or other plans. Borrowers should still expect past due notices from their servicers and calls if they are late on their payments. This is a different program than the COVID payment pause, where interest was at 0%, was not accruing. So they will be accruing interest, and these months on-ramp, they will not count towards PSLF or IDR forgiveness. So it's very important that in this case, if you really think, if you go through the loan simulator, plug in your information, and your payment is still going to be too high for you under the new repay or save plan, you just can't make that payment, then you have this option. But again, interest will accrue and you will not be receiving count towards forgiveness. So really explore your options and see if this is the best for you. Next, please. Again, fun facts or some takeaways: interest will begin accruing September 1st. So regardless, the payments start October 1st, but your interest on your loans will start September 1st. Borrowers may have pre-COVID outstanding interest that will be added. Your first payments are due October. So you will receive a billing statement from your servicer with your payment due date, upcoming interest, and your payment amount, and your payment will be due no sooner than 21 days after your servicer sends the billing statement. And you can probably log on to your servicer account right now and find out when that payment is due. No IDR certification. So as part of being on an IDR plan, you are required to certify once a year. No IDR certification will be due at least 6 months after the payment pause ends. So after October 1st, you won't have to certify. For those that do want to certify to get on a new plan, they can self-certify for 6 months after the end of the COVID-19 pandemic. And you will be able to self-certify, which means that usually you have to submit documentation. During these 6 months, you won't have to submit any documentation to recalculate or certify. Automatic forbearance will be used if borrowers become delinquent, and if borrowers become past due, collection attempts will still occur. So you do have the options of your IDR plans, the new IDR plan, and then on-ramp. So that way you avoid getting into delinquency, which then could lead to default. And that's what we want to avoid. Next, please. And then one more thing that I just want to point out, we're getting a lot of borrowers who are reaching out, student loan scams. So there's a lot of scammers out there that are using this time. They're using everything that's going on in the news. They're taking advantage of borrowers' confusion, which we understand is confusing, all this information. And they're reaching out to borrowers via email, via phone, via mail, and they're basically promising loan forgiveness. They're promising that they can help you lower your payment. They can help you consolidate. Many times these companies are just document processing companies, paper processing companies. They don't even know student loans. Their letters will look official. They'll have official seals, but please read the fine print, understand who you're dealing with. They won't have official sounding names, and they will charge. So they're offering these services and they're being very aggressive in their tactics to reaching out borrowers. They want you to subscribe to a service, subscribe to pay some money basically. And what they're doing, they're not going to be able to help you. There's nothing that they can do that you can't do for free. There's tons of free resources, information, agencies that can help you like DFPI and TISLA without charging a fee. And all they're going to do is they're going to get you in these contracts and and then they're going to then they could steal your identity because they're asking for your studentaid.gov login information. And there's a lot of information there that you don't want. You don't want out there because it is linked with IRS and all your information. So do not subscribe, only work with reliable agencies, and you can file a complaint with DFPR or the FTC if you have been a victim of fraud. So we want to know of these scammers out there that are targeting student loan borrowers. Next, please. It looks like we are right on time. And these are some of the resources, the studentaid.gov. We've mentioned the student loan simulator, information about the income-driven adjustment, fresh start for borrowers in default, more information on TISLA's website on deferment and forbearance, and then overall income-driven repayment and PSLF information, which we didn't cover a lot of PSLF, but we will be doing a webinar just on PSLF, our Back on Track page and YouTube channel where this webinar will be published. Betsy?
Great job. Yeah, I just want to reiterate a couple things. This is number 2 in a series of 5 webinars that the Rose Foundation was kind enough to give a grant to make sure that this information was available to residents of California. And so a lot of the topics we weren't able to cover today are covered in the rest of the series that's coming. So be sure to check the DFPI page for the dates of those and topics of those other webinars. As Selena mentioned, another one is specifically on PSLF. Another one is specifically covering your rights as a student loan borrower, both within the state and at the federal level. And I'm drawing a blank on what the last one is. Shame on me, because I'm building it. Anyway, it'll be a surprise when you go to the website to see. Uh, I also, again, we did not have the time to cover the one-time account adjustment. I strongly urge you to read up on that on the link that's in front of you. And I'm happy to, oh, one other thing I wanted to mention, the on-ramp, Selena did a really good job explaining it, but I'm just bringing this up because I get a lot of questions about it. You don't have to sign up for the on-ramp. Basically, what's going to happen is in the first 12 months of repayment, starting in October, if you fail to make your payment, you're going to be delinquent. They're going to call you. They're going to send you letters saying, hey, don't you owe this payment? But they're not going to report you to the credit bureau if you're 90 days delinquent like they usually do. And you're not going to default within those first 12 months. They'll just automatically going to put a forbearance on your account and try to get you on a plan you can afford. But interest is still going to accrue on your loans. Everything else is the same. The only thing the on-ramp really does is prevent your credit from tanking for non-payment during those 12 months. It's nothing you have to sign up for. That's just how they're going to do it for anybody whose loan is currently on the COVID pause. Happy to hang out to answer other questions that people have. I'm going to take Addison, is there anything that you think we should cover that we should discuss?
Nothing major. They've actually been a fairly quiet group today.
Okay. I see one right now where someone's asking, I heard that if you pay student loans on time, you don't accrue interest, but Parent Plus loans still have the predatory interest rates. All of that entire statement is false. Interest always accrues on federal student loans, and it accrues on a daily basis, unless you are getting some sort of interest subsidy on an income-driven plan, or maybe you're in deferment. And on the income-driven plans, if your payment amount is more than how much interest you're accruing per month, you're not getting even an interest subsidy there. So it doesn't matter whether your payment's on time or not, interest is going to accrue on your loans. And that applies to both Parent Plus loans as well as Stafford loans and Graduate Plus loans and consolidation. The interest rates are set by Congress. If you think your interest rate is too high, you should absolutely write your member of Congress and ask them to change that. I know some federal student loan borrowers who have an interest rate of 1.88%. I just saw one of those yesterday. But I also see other borrowers that have interest rates of 8% under the federal student loan. And that has everything to do with when you took your loan out. So again, it's set by Congress. There's no specific link just for Parent Plus loans. With every topic, sort of the Parent Plus information is sort of woven in there, but it's an interesting idea. Maybe at some point, maybe we'll create a page just for Parent Plus borrowers on the TSLA website. Thank you for that idea. Someone else asked, I read an article that suggested a good tactic was to pay off the interest if you can before the October restart. Absolutely. If you have interest that accrued prior to the COVID pause, that's still sitting out there, and you can pay that off before payments restart, that's a great idea, because that means that you can be sure that at least some of your payment will be going to principal once payments restart. You should know you can never prepay interest, though. So there's no way to pay all your interest off and no interest will ever accrue again. You're accruing interest on a daily basis off of whatever the principal balance is at the time, which is why the quicker you lower your principal balance, the less you pay in interest over time. Someone's saying if you take a loan out now, then your interest will be high. Well, depends on your definition of high. It take me a second to look up what the interest rates are for loans taken out this year, but I think they're in the 5s. So, for someone who has an 8% loan, they might not think that's high, but someone who has a 1.8% loan, they might think that's high. Do you do anything about using student loan to use towards first time purchasing a home? Well, that's illegal and fraud. Full stop. When you sign your promissory note, you explicitly agree that you are going to use your student loan towards educational purposes and costs only, and those are defined. And buying a home is not one of those things.
Or paying off other debt. Correct.
Or paying off other debt.
Mhm.
All right, so I don't see any other outstanding questions.
Thank you so much, Betsy. This is, I don't know, we might have to have another one of these, but thank you. Thank you, Addison. Thank you everyone for joining us. Again, this will be posted on our YouTube page. Please keep in touch. I know there's a lot of information. Betsy, any last words?
No, I mean, I thank you everybody for coming. The borrowers that I find that are most successful managing their student loans are the ones that educate themselves. So congratulations for taking the time to come to this. You're going to be a lot better prepared than most of your colleagues. So thanks everybody.
Have a good